On the Express this week, the stock market is partying like it's 1999, but this time we are wearing gold. There's an ETF for this, for that, and just about everything else. Ian Dunlap, the master investor, joins the show to drop in for a few good minutes, and why job hugging is the new it thing at work. The Investopedia indicator, and what to watch this week. If you're riding the Express, you're rocking with the best. Welcome back and welcome aboard. Greetings to all of our live viewers, watchers, and listeners all over the world. We love hearing from you, so drop your comments in. We want to know what's going on in your part of the world. Right now, stock market a little bit soft. Hey, there you go. Panda Nation's in the house, of course, because we got the master investor, Ian Dunlap, coming up in a few good minutes. Here they are. All right, Outlaw Training, they're all here. Let's go on a Tuesday morning. That's right. Usually on Mondays, but this week, because of Labor Day, we're here on Tuesday. We are live and direct. Michael Thomas, welcome to the Investopedia Express. Hey, we love you too much for you. Thank you so much for the comments. Keep them coming throughout the show. We got a busy one ahead of us and a really busy week. So join the conversation live here on all platforms and then on demand, wherever you get your favorite podcasts. And let's get into it because it's busy. Summer's over. And that rally that powered us through the month of August, that's fizzled a little bit to start the month of September here. A ton going on in the news. Stock market a little soft coming out of the gate to begin the shortened holiday trading week here. We got a spike in long bonds here, concerns about whether these tariffs are actually going to be implemented or whether this district court can actually hold them up or what comes after that. And then you see a lot of pressure on long-term treasury bonds. That's all about the soundness of the U.S. government policy here and our economy going forward, and a record high price in gold yet again. We'll get into that in a minute or two. But hey, coming out of the summer, we were feeling like Rocky, flying higher. Nobody likes Sly Stallone, and we did have a heck of a summer. When you think about asset prices, we had record highs across the board here. Let's go higher. Take me higher, Sly and the Family Stone. Gold prices at a record high, 8 months in a row on that. More on that in a second. Silver prices, hello, at a 14-year high. The Dow Jones Industrials hit a high just a week or two ago. So did the S&P 500, the 20th all-time high of the year. The NASDAQ, of course, at record highs. And Chinese stocks, you'd think they would be a little bit softer given all the tariff talk. Actually, the CSI 300 at an all-time high. But we also have stock markets around the world like Greece, Poland, Austria, powering to new all-time highs as well. It's a melt up of asset prices. What's behind all of that? Are we headed into our own little moment of irrational exuberance? You got to wonder. And maybe that's because investors feel the prospect of lower interest rates around the corner here. And we're going to get a Fed meeting in a couple of weeks here. And we have a key week here for the jobs report and a state of the labor market assessment here that's going to give us a little bit more power. But you got to wonder at the rally in gold prices, which are at another record high. Gold has had 8 months in a row of higher highs as you have this concern. You had another record high this morning. Concerns about the soundness of the U.S. dollar. Is it going to still become the dominant and continue to be the dominant currency going forward? You have concerns about U.S. treasuries. And this chart that's got everybody scratching their heads and worrying a little bit on Wall Street, coming out of Bloomberg and Crescent Capital, on central banks around the world holding more gold than U.S. treasuries. And that has been the trend, my friends, over the last few months. And as you see this tariff talk get ratcheted up, you see more central banks holding gold, more holding the physical asset of gold in their vaults. And why are they doing that? Well, they're concerned about what happens when these tariffs actually go into place and this end of the era of globalization. Does it mean a weakening of the U.S. economy over time? Does it mean more spending by the U.S. government over time? And all those things might be true. And they would rather probably hold a physical asset like gold than potentially own U.S. treasuries. We've seen some softness in U.S. treasury auctions, and that should tell you something. when central banks around the world don't want to hold the most widely held asset that they've been holding for the past 100 years, that's US Treasury bonds or US dollars, and you see the BRICS countries, that's Brazil, Russia, India, China, and South Korea, all getting together here a little bit more, you see why they're starting to hold a little bit more gold and wanting to hold more gold than US dollars and US Treasuries. Meanwhile, in the stock market, we have had the trend as our friend. We've had the wind at our backs because of the prospect of lower interest rates, because of better than expected corporate earnings. They're usually better than expected. We all know that game, but we've had a lot of momentum, not just in the top 10 stocks, but across the market, small to mid cap stocks. And don't call it a comeback. The revenge of small cap stocks is very real over the last couple of months. Why are small cap and mid cap stocks rallying so much in the last couple of months? Well, they love lower interest rates. Those small mid cap stocks, they take on a ton of debt. But that's why when rates are headed lower, you see those start to outperform. And for the whole, I don't know, 12 months, last 12 months, people have been talking about the small cap rally's got to get going. The small cap rally's got to get going. Well, the small cap rally's going right now. And you have a pretty good breadth across most sectors of the stock market, even though everybody focuses on the top 10. And we'll get into that a bunch in a few minutes with our buddy Ian Dunlap. It's this breadth across the market that's got people thinking maybe things won't be so bad in the stock market. And we've had this melt up in assets, but are we headed, I say, for our own moment of irrational exuberance?
But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions, as they have in Japan over the past decade?
A lot of you folks are too young to remember that speech back in 1996 at the American Enterprise Institute, but that was Fed Chair Alan Greenspan worrying about the bubble up in assets, especially in dot-com stocks, which eventually imploded or exploded all over the place, but also generally asset prices in the 90s were bubbly. And as soon as he said that, you started to get a little softening there. And by the time the dot-com era came to an end, we had a 50 to 60% haircut in the stock market. And when you look at reasons to think that the stock market's overvalued, there are plenty of them. We got a forward PE ratio now of 22.5, right? That's a 25-year, that's the 25-year average is 16.8, so we're about 35% higher than that. The price to sales ratio is at 3.23 times. That's higher than it was back in 1999. You got the Shiller Cape ratio, right? The cyclically adjusted PE ratio that really measures earnings over a 10-year span. You got that almost double the long-term average, and you got a price to book ratio, right? What are the stock prices of these companies compared to the assets that they actually hold? You got that at 5.3 times. That's much higher than it was in the last 20 to 30 years, but certainly higher than it was in 1999. Yet, we got markets still near record highs despite the softness to start the month. So we're going to get into this with our good friend, Ian Dunlap, the master investor on the drop-in. Let's get into it. Let's bring him in. Welcome, my friend. So good to have you on the program.
Good to be here. Good to see you as always.
This is, if you don't know, now you know. Ian Dunlap, the master investor, founder of the Red Panda Stock Club, creator of Market Mondays on EYL, where I have the privilege of joining the show every once in a while. You become a good friend, and he is another comrade in the fight for financial education and teaching people how to invest. So good to have you on the program. So good to see you back at InvestFest a couple of weeks ago, my friend.
Happy to be here. Love the soliloquy in the beginning. A lot to talk about with exuberance and the bond market in combination. So I'm always happy to chat with you, a great friend, a great person, and one of the people that I respect the most when it comes to the market.
Thank you, my man. And we're so happy the Red Panda Stock Club chiming in with us as well. A lot of your members follow you wherever you go, and we're happy to have them join us on the ride on the Express this week. And shout out to our guys in Indianapolis who I met from the Red Panda Stock Club a few weeks ago back in Investors. Yeah, they're in the building. Monique's in the house. We love it. Chime on in. All right, Ian, I got to ask, are you surprised by the market's resilience, how strong it's been over the summer? Or are you sensing all the same things that I've been talking about?
I'm feeling the same thing that you are. The exuberance is definitely is priced in. And I was just talking to the stock club earlier. no one's talking about the bond market being in drawdown for 61 months. The previous record is 16 months. And it's almost as if, because the AI wave is here, Nvidia leading that no one cares about this potential black swan event that could happen. Everyone, I think, is looking past that, and that is a definite cause for concern. There's not as much talk about the Russell as you illustrated. The mid caps and smaller stocks are doing well, but it's almost all attention is like on tech, and we're so hyper concentrated. I haven't been this worried probably since maybe 08, 09, or maybe early 2020. It's definitely given a cautionary tale that we could be walking into.
Yeah, when you say that, people should be paying attention because even in some of the best of times, you've been cautious and been right about that. But also, you can't help but look at the bubble up in assets, and we've all done very well by holding Nvidia. Let's look at a couple of charts. Your crew is so chiming in so hard here. I love it. Let's look at a couple of charts of Nvidia. We talk about that over concentration, but just as a couple of them that got my attention from our friends at Bespoke. This company at $4.4 trillion is bigger than most countries out there in terms of GDP. So when you see a company that big, and we've had this before in concentration, the GEs of the world, in the railroads of the world, and we've talked about it on this program, we talked about it on Market Mondays. It's bigger than most countries. It's also many times the size of many companies in terms of market cap. So you got one company and you got an industry that's sucking all that investor money into it and all the attention. Why does that worry you when you've been able to run this up?
I mean, if you look historically, this happened with, like you said, GE, Standard Oil, IBM. At some point, you're going to have a reversion to the mean. I do think that Nvidia is an excellent company, but even if you look at the concentration and revenue sources, they're dependent upon 4 or 5 companies for revenue. And historically, when that happens, there is usually a compression. Now, of course, I know they're going to make the chip for China. That's going to be allowed, I think, in the future. But normally, I don't like to see a market that is so frothy where it doesn't almost make sense for the kind of gains that you're looking to get. Like the gains that we've been able to get in Nvidia the last 5 or 6 years are comparable to what option leap calls or futures trading would be for a good CFA. That's not the norm. And if you look at some of the other tech companies like maybe Cisco or Salesforce, while they're great companies, they haven't been able to keep up. And I get concerned when the risk to reward ratio is so skewed towards so few companies, and almost like 480 other companies don't even get mentioned. So that's why I think, of course, time in the market is very important, but knowing when the cycle of when to exit or take some money off the table is incredibly important.
Right. Which brings us back to this question that's been bothering me for, I don't know, months now. This question of diversify or not to diversify, or what does diversification actually mean in 2025? Because if you say, well, I'm diversified, I own a bunch of ETFs, and those ETFs actually hold the biggest stocks in the market in them. And I have a bunch of stocks, some of my favorite stocks, which are also the same, that are the dominant stocks in those ETFs. I got my index funds. I've done what I was supposed to do. And I've done very well by it. So should I diversify outside of that? What does diversification even mean? If you were in a 60-40, you mentioned the drawdown in the bond market. It's been a terrible place to be.
Yes. I think concentration is great to build wealth, and then diversification is great to protect the wealth. I talked about this at InvestFest. From a risk analysis standpoint, it is almost backwards in thinking. But for me personally, me being heavily invested into Microsoft and Apple the last 12, 13 years has given me a great windfall. But I've always been a big proponent of investing in index funds for the drawdown reason as well. So if the tech market goes down like a 99, 50%, indexes should go maybe down maybe 20 to 23% worst case scenario. So it's a great anchor and place of protection. But I think we're in one of the most interesting times in history where some stocks are giving record gains while and of course crypto as well. But like we said, the bond market is in a historical drawdown for 61 months. And it should be if tech was down for 5 years, the world would be on fire. It would be front page news for ESPN, ABC here. And I don't think enough people are putting enough focus on how big of an event that could be tied in with the inflation story, interest rate story, the repositioning of the dollar potentially. And like you said, when countries are not picking up treasuries and they're leaning towards gold, that is frightening. We're like living in the new version of Wall Street, except Michael Douglas is not here to guide us and tell us that greed is good.
Yeah, wake
It's,
up, pal.
it's
Right?
fascinating.
Time to get to work. And how do you get to work today? So you talk about index funds being a great place to anchor and a great foundation. And that is how so many of us have built our portfolios. You anchor with big index funds, you build
Yes.
big positions there, you pick your favorite ETFs, you build your positions there. That's your foundation. So if you get
Yes.
rocked, you know you have some stability. But if you were doing it today, you were 25 years old today, how would you do it? You and I got this question endlessly at InvestFest, and I get it all the time. How should I start? I'm worried about these things, that these assets at record highs.
I will always say if you have no children, wait for a 15 to 20% drawdown, which we'll have soon. Look to buy into tech because tech has been a category that has run the United States economy for the last, let's say, at least 40 years. If you have children, that's when I lean more towards diversification. So I would do 2 index funds or 2 ETFs, and then I would build another 2 positions into tech. Ideally, you want the first 2 that are biggest in market cap. You do not want to buy at the highs, and I think you have to have a minimum 5-year hold. Now, I know the question is Nvidia. When do I get in? You have to wait for a pullback. Even with Bitcoin, when Bitcoin got to an all-time high, it dropped some, it got to 108, and people are like, oh, it's going to crash. I'm like, no, it's just reverting to the mean where it should be and given a fair value price. So I think the price of where you get into the asset matters a lot as well. And also, I think it's really important to not deviate from what your long-term plan is. I think a lot of people go into investing incredibly optimistic, and almost every month they want to change their plan. Like I think retail investors get caught up too much in sector rotation opposed to finding a 10-year plan that's going to work for them. Anchor with index funds, add to it with tech, and then invest in the best companies in the world and hold them for a long period of time. You'll be fine.
Yeah. The whole idea, though, is to keep doing it and add to your positions.
You have
How many
to.
times do you and I look at portfolios and someone's like, take a look at what I got, and they have 30, 40 stocks in there. And you're like, yeah, you have 1 or 2, 3 shares in each. That's
Yeah,
not going to do it for you.
it's not going to
You
move the
got to
needle.
load up the truck with the highest quality assets you can and really make a meaningful contributions, build positions so that when you get movements like we've had over the last few years, or really over the last couple of decades, when you and I got serious about investing, it actually means something for you. So you mentioned if you have kids, maybe be a lot more diversified, have those index funds. And I totally get it. I got them and I have done that. I have played by that recipe. And if you don't, well, you can actually take your time, and you can also suffer a loss and not have it totally to wipe you out. So we just came out with this, the Investopedia today. The price, we do it every year, the price of the American dream. We actually put a price tag on it because there's all these concerns about the fact that people, especially younger people, don't feel like they'll ever be able to buy the home, have enough to retire, right? Be able to raise kids, send them to college. You and I are both in the middle of that ourselves, raising kids, and mine are off in college right now. $5 million, Ian. That seems like a big number, but when you work back from that number and you think about the fact that if we work our whole lives at the median income, we're going to make about, I don't know, $3 million. There's $2 million you got to fill there if you want to just afford the basics, right? These
Yes.
are not necessarily the needs, these are the wants. But that's where investing comes in. What does this number mean to you, $5 million?
It's grown a lot since I was 18, and it illustrates how important it is to invest. Like even Vlad at Robinhood, who we have a good relationship with, it's interesting to see tech CEOs at scale come out now and say investing is mandatory, or you may be financially included in the underclass that will not be able to recover. I love that investing has gotten more popular than ever. The interesting part is it got more popular than ever as we start to have decay in our overall economy. So much so that even the United States government is acting like a venture capital firm by investing into Intel and possibly into Palantir and others. Like the writing is on the wall. Like regardless of what you think politically, we're seeing deals being done in the White House as a hedge for the American government and their own personal economy. So it's interesting to see this number be 5 million because often I'll get pushback when I give a number like that, but when it's broken down like this, you can't deny even the cost of childcare. over the last 10 years has went up dramatically. So when you factor that in, cost of a car, education, you have no choice but to invest. Otherwise, you're going to end up broke, or even worse, in a ton of debt.
Yep. Yeah, the writing is on the wall. And if you are not in the investing class and if you are not in the asset ownership class, you will be left out. And that's what I know that you and I have been preaching for a long time. I know you teach that through the Red Panda Stock Club. And I don't, it's just the reality. And there's a reason that you had 25,000 plus people crowding into InvestFest this year. It gets bigger and bigger every year because people know that if they're not in, they are out. All right, I want to give you a little quiz on the on the best performing stocks of the past 10 years on an annualized basis, right? When we think about the best performing stocks, the stocks that have been the strongest, a lot of them come to mind immediately. And I bet you could name a few right off the bat. But when I looked at this list of the top 10 performing stocks annualized over the past 10 years, I was thinking to myself, no wonder I can't pick stocks. Who would have known that a lot of these companies were going to end up being leaders? So give me off the top of the dome, Ian, 2 or 3 that you think are on that list. And you're probably going to get them right. But the others, I bet you you'll have a hard time like I did.
Shockers, yeah. I would say Microsoft, Nvidia, Tesla. Surprisingly, Build-A-Bear has been done fantastic. And let's throw Palantir in there, even though they're relatively new.
All right, let's show the full screen here because I was shocked by a lot of these. You had Nvidia, right? Microsoft is not on that list. You got 2 or 3 chip companies in AMD.
Okay.
KLA. These are annualized. This is on an annualized basis, right?
Yeah.
36.5% a year for annualized for KLA, 80% annualized for Nvidia, which is why it gets that claim of the wonder stock. Even Tesla with all of its drawdowns, but you have companies out here like Monolithic Power Systems, Texas Land and Power, Arista Networks, Cadence, right? Axon that you and I don't follow. Most retail investors don't follow, which makes stock picking so very difficult. Going back to your point about why it's important to index, why it's important to own ETFs, we couldn't have picked a lot of these. Nvidia maybe, but most of these, this is a surprise to me, right?
Absolutely, especially Monolithic. I mean, great company, but I didn't know that they were at 35% year over year. And think of if Elon and executive management could have stayed the course and not been so interested in the media, which caused some of the drawdown and then the kerfuffle in Washington, they probably would have been at 45% annualized gains.
Yeah. And this is how you actually build wealth in your portfolio. But who knows who the next Arista Networks is going to be until you know it's the next Arista Networks. A lot of people were onto Nvidia. Nvidia's didn't just get here. It's been around since 1993. A lot of these other stocks, very hard to pick the winners. So who do you think, and I'm not asking for stock picks, but out of what sector do you think the next decade of winners is coming from? Is this the next leaps in AI for you, or what sectors are you looking at?
For sure. I'm looking at AI for sure. I think OpenAI, when it goes public, will do incredibly well. I think Anduril will be a power player. And then if we ever have any breakthroughs in quantum in the next 10 years, I know people were early to invest into a few companies that were quantum adjacent, but I don't think we've seen the leaders yet. I think AI will have a great, but OpenAI I think will be probably stock of the decade once they go public.
P.S. You don't have to wait for a lot of these companies to go public anymore. Everything is being securitized and tokenized. You can buy shares of these Anthropic and others in the private market, and this merging in of the public and private markets, sports betting, right? Probability betting, options trading, day trading, the securitization of everything and the tokenization of everything. This is all wide open now, isn't it?
Do you think the convergence of all of these different asset class and ways to invest is a way to offset the job market that is falling apart while the bond market simultaneously is falling apart as well?
I think so. And I think people just like gamifying everything, especially younger generations. So this notion of the marathon of building wealth through long-term investing is harder and harder for people, especially younger people, to put their minds around. But that is the only secret that I'm aware of. You could get lucky, but you have to be in the game and you have to be invested. So I think it's all people want it right away, and they see it right away when they're watching people betting live or their favorite celebrities betting millions of dollars on a sporting event or betting on the outcome of the election. I think they want that right away, and they're going to find it any which way. And you see the platforms like Robinhood and others offering now sports betting and other types of activities. This is where we're headed one way or the other. Am I right?
I agree. And the cost that we just illustrated it, the cost of the American dream is $5 million. That's I don't want to say for basics, but that's without any extravagance added to it. And a job economy that isn't as secure. I remember when I graduated in 2005, the thought was if you went to college, you were guaranteed a job. That fallacy is long gone. So I think people are realizing you have to do other things in order to offset whatever money you are not making in your career or your career pathway. And I definitely think this is here to stay, but I'm definitely concerned about the economy overall.
Yeah. Yeah, you and me both. Interesting times. All right, what's going on at the Red Panda Stock Club? You got so many loyal members of that club who just love learning with you, and you've really grown this into a beautiful community. I had the chance to hang out with a bunch of them at InvestFest, but everywhere I go, and people know me because they see me on Market Mondays with you, or you and I are buddies. So it's really been embraced by that community. What's happening at the club?
It's really my community to give everything that I've learned about investing. When I first started in 2008, I didn't have a community to go to get easy access to information because the information was so much to take in. It was hard to get a very concise answer. Contrary to popular belief in 08, 09, there wasn't an easy place to go to say, should I buy this company, yes or no, or what price? So what I love to do is combine fundamentals with technical analysis. And I give the prices of where to get in for about 60 different companies. We have a quick entry price, a swing trade price, and a low to boat price. And they've been absolutely amazing. I had a great time with them at InvestFest. Thank you to everyone who was there in Atlanta. Thank you, Caleb. I think the performance was amazing, but I just love giving back to that community because it's a community that I wish I had when I started. And truth be told, investing is a lot easier if you have other people to have conversations with and run your ideas across as well. It's very tough to invest incredibly well if you're in a silo. And I just try and lead them well to get them gains. And if I made you money, please put yes in chat. I love Investopedia, and I love you too, Caleb.
All right, man. I love you too. Yeah, you do a great job. You're one of the great educators out there, one of the great communicators in our business, but really a true friend. And I appreciate you coming on the Express. Shout out to you and all the folks at the Red Panda Stock Club. They've just been chiming in left and right with some love for us, and we love you back. And thank you, Ian. We'll see you
and
soon.
On a personal note, from a creation standpoint, you guys are doing an amazing job at this show. Like just the density of information, the love that you give to the audience is second to none. And I think that's why people love you so much. Even just watching the show myself, I'm always getting ideas and how I can illustrate these points a hell of a lot better. And you're one of the best, and I love you dearly. Always have been a big fan of Investopedia, but from a content creation standpoint, my God, what an amazing job you're doing.
Thank you. Thank you, man. That just melts my heart. That's why we love having you on, and I'm so glad that we become friends over the years. Shout out to you. Shout out to the Red Panda Stock Club. Shout out to Market Mondays and all the folks that tune into that. We'll catch up with you soon, my friend. But make sure you're following Ian at the Master Investor. Check out the club. Check out all the great content he and the others are putting out there. And we'll talk to you soon, my friend. All right, let's get to some money in motion because it is ETF-a-palooza, my friends. We were talking about the securitization of everything. We're talking about the fact that there's a lot of different ways to invest. Well, this, my friend, our good buddy Sam Rowe, wrote an article last week for the FT on the fact that there are more ETFs out there right now than single stock securities. And eventually we are headed to this. There's the article right there in the FT. Check it out. More ETFs than single stocks. Cool chart there by Morningstar that people are picking up and talking about. And yeah, there's an ETF for just about everything. And this, in the last 30 or so years since the first came out, has just exploded in terms of numerical value. And I just want to get into some of the points that Sam makes here in his terrific article. According to Bloomberg, U.S. ETF assets have ballooned from $4 trillion at the start of 2020 to a record $12.3 trillion today. The market's had its ups and downs over the past 5 years, but the trajectory of ETF adoption has been relentlessly upward. And as Sam writes, ETFs are no longer a niche product. They are the market, and they have been the avenue for so many retail investors to start investing and join the market and become diversified. We're just going to get more and more ETFs over the years. I've talked to experts like Anna Paglia at State Street and others who have talked about the fact that maybe we're at, 8,000 or 9,000. We're going to be at 20,000 ETFs over the next decade, and assets have been flowing out of mutual funds and ETFs for a very long time. This trend, money in motion, this is a long-term trend, but it is telling us something about the appetite for the retail investor and institutions who own a lot of these ETFs as well. But there's an ETF for just about everything out there in the world these days if you want to securitize it. All right, let's get set up for a really busy but shortened trading week ahead. All right, we are off for Labor Day, but it is a Labor Week. Nice one, Taylor, suggesting that joke there. It's a labor-related week. The jobs report for the month of August will come out on Friday. Everything's centered around that. Everyone's focused on the jobs report. How strong is the labor market, especially after those deep revisions we had for May and June, and that weaker than expected number we had back in the month of July. But construction spending out today for the month of July, we know that's been sort of slow. Manufacturing is starting to slow a little bit. Concerns about the broader U.S. economy and the health of it, especially as those tariffs set in. Some earnings this week from companies like NEO and HPQ. Today, we'll get earnings from Salesforce. We'll get earnings from Dollar Tree and Lululemon and Broadcom, one of the top performing stocks of the past 10 years. And earnings, my friends, have been better than expected. And the outlooks for future earnings next quarter, the quarter after that, even next year, have been rosier than expected. And that's one of the reasons why the stock market keeps powering to record highs. We'll get that jobs report, as I said, on Friday for the month of August. Can we depend on the data? Are we going to get actual data here we can all agree on? Or are we going to have more doubts about that? But meantime, what is actually happening with the unemployment rate? What are companies saying about hiring? But before all of that, the JOLTS report, the job openings labor turnover survey, that is going to give us our indicator of the week. And as I said earlier, we're going into September here, one of the weakest months of the year for the stock market in general. But we could have yet higher highs if we get to the better than expected earnings. As I said, we get some resolution in tariffs here and that rate cut by the Federal Reserve September 16th and 17th. A lot of people circling that in their calendars. So keep a close eye on the month of September. We thought August would be weak. It was a pretty strong month after all, and a pretty strong summer as all assets melted up in terms of price. So let's get to our indicator of the week, and I teased it already. It is the JOLTS report, that job openings labor turnover survey. We're going to see how many people are actually staying in their jobs, how many people are quitting their jobs. It's the quits rate that I'll be focusing on this week. That's our indicator of the week. And we want to look at the beverage curve on the quits rate. This shows the relationship. This is an economic concept that shows the relationship between job vacancies and the unemployment rate in a labor market. And if you look at the quits beverage curve here, and the beverage, and I don't mean cold, tasty beverage, I mean the beverage curve, an economics curve there. There's a chart by Indeed.com that tells you that less people quit when the unemployment rate rises, which is pretty obvious. But you think about how many people were straight up quitting their job a few years ago coming out of COVID. We had all that job hopping. We're not getting that anymore. We're getting job hugging. And that's what we're going to focus on when we get that JOLTS report this week. How many people are quitting? How many jobs are available out there? And what ultimately is the state of the labor market? Because if we don't feel good about our jobs, we're not going to be spending. And if we're not spending, the economy is going to be slowing. Tariffs or no tariffs, that is the secret sauce right now. When you look at a lot of the movement in the asset prices, that tells you a lot of people are starting to get even more concerned. So that's what we got this week. So many people chiming in. Mr. Monte, thanks for the great information. Thank you for jumping on in the show and dropping your comments here. Ian, straight cold. That's right, Adoze. He is straight cold. He is one of the great educators out there and a great friend of mine and a great friend of ours here at Investopedia. Hey, much love to you. Thank you for the shout out. We love that polymath there. Two of my mentors on one video, Shameless, Son of Wall Street. Thank you so much. We love the comments. We love the love. And this is a community all about sharing the love and the education. And no one does it better than my friend Ian Dunlap. Pierre Charles, thank you for chiming in. Shout out to you wherever you are. Yeah, back to Monday next week. Back to the usual schedule. And next week, we'll be at Future Proof in Huntington Beach, California, coming to you live and direct from the beach. Future Proof, one of the great conferences by advisors, for advisors, put on by our friends out there. Future Proof is the ultimate Financial Services Conference. They have taken it to a new level. Excited to be out there. Excited to bring you the show next week. Thanks again to our buddy Ian Dunlap for jumping in on the show. And thanks to all you for chiming in. A lot to take in this short week, but let's go. It's time to get back to work. Summer is over, and we'll talk again a little further on down the line.